When the economic environment becomes uncertain, we provide the truth from a breadth of perspectives to help people make decisions. We not only compile and analyze the data that moves our ever-evolving economy, we carefully craft our own to provide clarity across industries, businesses, and employment markets. We identify unique opportunities to deliver asymmetric returns and focus on capturing value created during periods of higher volatility, transforming the financial landscape together. We're MacroEdge.
Good afternoon, everyone. This is John Galt speaking, and if you're hearing my voice, it means it's time. It's Friday afternoon, 4 p.m. on November 1st, 2024, and this is MacroEdge Radio edition number 27. Today is going to be a little bit of a different show, and for those of you who are not used to this kind of show, well, let me leave it like this. We're going to discuss markets. Duh. We're going to talk about the big picture, but we need something from our listeners. Every now and then, it's better to go to the source, to talk to the individuals. So after I review the markets, after we get through the initial blitz of economic data, which you could find by any fire hydrant provided by a puppy or a large dog, we will open up the quote-unquote phone lines to our listeners. Now, what we don't want to hear is campaigning. We don't want to hear a lot of talk about wars in the Middle East. I want to hear, and so does the MacroEdge team, what's happening in your economy. What's happening to our listeners? What's happening in your markets? What's going on with real estate in your region? You know, we can't travel everywhere at once. A lot of us get around a lot. My week, total disaster. Some of my largest customers are getting ready to lay people off for up to 6 to 8 weeks. And I'm not talking 5 or 6 people. I'm talking hundreds, perhaps thousands. I'm talking about people who are having to deal with reality on the ground. You, the MacroEdge listeners, are part of the team. You're the ones that fill in the blanks. Next week, we're going to talk about elections, the economy, and quite a bit more. But this week, the news stories actually are mind-blowing. And I'm going through the markets as they close. And it's one of those situations where you're going to hear a different story in the media than reality. And it should scare the hell out of you. And part of the show tonight, I'm going to taunt our listeners. Not on purpose. I want to see how smart everybody is, including members of the MacroEdge team who feel that they want to join in and take a guess at this. You can do it through our message system, which has extensive ability under MacroEdge, the at MacroEdge moniker. We want to hear from you about what you think the answer to this question is, and it's the number one investment vehicle in the United States markets at this time. And I'll give you a few clues, and we'll do this throughout the show. We'll sprinkle it in, and I want to hear what everyone thinks. I'll give you 2 of them. One of them, it has an absurd price-to-earnings ratio. It is off the charts stupid. And number 2, it's talked about almost every day by the talking heads in the financial media. You don't hear us touting it. We talk about it, but we don't tout. We don't promote. We don't try to sell something. We're here to report basic ABC 1, 2, 3 data and let everyone take a look from their own perspective. Everyone sees the earth from their windshield, from their sidewalk, from their picture window or their back porch. When you get up to 10, 20, 30,000 feet and look down, you see a bigger world. And when you start to zoom in on it, there's a lot of changes to what's going on. I'm not even going to report the Dow today. The Dow is 30 stocks. It had a really nice rally on totally abhorrent, terrible economic data. Why, you might ask, did stocks rally this morning? Well, believe it or not, the theory that minus 32,000 jobs, which is the actual number, was bullish because it means the Fed's got to cut rates like it's going out of style. That's a recessionary warning. they reported plus 12,000 jobs. 40,000 jobs that they reported were government-created jobs. Now, if any of you think government-created jobs present a great productivity gain for the United States economy, I have some stock trading tips from Nancy Pelosi to sell you. Oh, wait a minute. Maybe I shouldn't say it like that. I have some ideas that Enron might promote for you. Today's market really ended as a disaster. And it's not one of those markets that you'd say, well, it wasn't a disaster. Well, yesterday we had a massive intraday reversal on huge volume on month end. Normally, month end is the time you engage in what's known as window dressing. Now, that's illegal on Wall Street. So is insider trading. So is illegal hedging and options plays. So is a lot of other things. But every major house engages in it. And you say, well, if it's illegal, why is it allowed? Well, when the regulators are participating in it too, you got to ask a question. Who cares? Today's market, though, after the huge surge, was really nasty. And on an intraday basis was another intraday reversal. Not to negative, but it will look bad on the weekly charts. And a very poor start when you take the monthly candle for October and put it beside the first day of November. The S&P finished as of 4:06 p.m. Eastern Time, up 27.88 to 5733.33. However, that is 39 points off the intraday high. The NASDAQ up 150 to 18,245. Well, that's 118 off the intraday high. Listen to the words. Listen to what I'm saying. That should be a cause for concern. When you hear people talk about, wow, the market rallied off bad news, that means the economy is not as weak as it seems. Not really true, okay? You hear this and you see this. We've witnessed this before. 01, 08, 09. Everyone thought when Bear Stearns was fixed, everything was cured. Everything was going to be awesome. Everybody let me know how your 2008, 2009, and 2010, 11, and 12 went. It sort of sucked if you were on the wrong side of that trade. Meanwhile, over in metals, we had a nice sell-off yesterday because somebody had a cash call. Gold's finishing the day down about $5 to $27.44. Silver, after being up earlier, is down 24 cents. We'll call it 25, rounded up to 32.55. Copper was flat. Ags were terrible. The Widowmaker is killing everybody. And crude oil and Brent, WTI and Brent, rallied hard in the morning because there was a leaked report. Translation, some big house was long energy. And they said, quote, Iran is going to retaliate against Israel. With what? Get real, folks. Start looking behind the headlines. Iran has no strategic or tactical advantage to attacking Israel at this time. This myth that, well, Trump's going to get in the office and he'll be Billy Badass against them. Calm down. Our elections aren't going to be over with until the middle of January. The reality is, crude oil and Brent finished the day telling you exactly what's about to happen this weekend, which is a big fat nothing. WTI up 27 cents to 69.53. Brent up 32 cents to 73.13. Now that we've gotten through that part of the program, let's get drop another clue about the massive investing vehicle in U.S. markets. Number one, another clue is it's overinvested. I'll let you think about that along with the other two. Next up, we have a move in the bond market today that was nothing short of dramatic, off the charts. What am I talking about? Well, initially this morning, off of the so-called great economic numbers, which there will be in-depth articles about that this weekend on MacroEdge.net/Ozone. Subscribe today for your 2-week free trial. The bond market rallied a little bit. And God only knows why. But once those shorts were covered, it felt like a brick. The 2-10 spread blew out back 5 more points to 17 basis points. That wasn't the big news. The 10-year 3-month spread leaped up 13 basis points to a negative 0.14 or 14 points. And that is something that should cause concern. Almost a 50% increase in one day. That is about the most blatant red flag recessionary, oh hell, it's about to break loose signal. I think you can pretty much justify. And I've got bad news for all the talking heads and bubble visions and whatever the hell else you want to call them on internet touting services and the FinTwit crowd. Once this market blows through flat, it doesn't move in 5 or 10 or 15 point moves during the week. It will move in 20 basis point leaps without fail and punish the living snot out of anybody on the wrong side of the trade, which means the recession is well underway and people are going to be caught short. What do I mean by people being caught short? Because I'm opening the phone lines up to our listeners in 5 minutes, and I really want to hear what the economy is like in your location. There was a tweet, X posting, whatever, by Christopher Whalen. If you're not familiar with who he is, he has a web service called Institutional Risk Analyst. He was one of the most intelligent and brilliant individuals and souls to follow during the 06 to 12 banking crisis and real estate crash. Not so much for the real estate side of it, but for the banking side of it. And if you listened to his words, you read his works, you would have an understanding of how he was trying to warn that this was easy to predict. It was all predicated on total mismanagement of policy and the dangers that are ahead in the short term and long term for bond markets. Now, everyone dismisses the bond market because it's not dramatic, it's not flashy, it's not as great. The big part of the opening of The Big Short where they say, hey, let's get sexy, and the guy spills mustard all over his tie and introduces RMBS to the world. Well, that was dramatic. But then again, anybody with wads of $100 bills at a strip club is dramatic. Let's get real. Chris sat there and hit a home run. You can't see this article until Monday, November 4th. If you subscribe to his service, read his website, it's available. I highly recommend subscribing to it. His title is Fed Duration Trap Threatens Banks and Soma. What? The Fed's in a duration trap? That's impossible. They're the smartest people in the room. Why is this important? The system open market account of the Fed is moving asymmetrically. I'm reading from the article, with relatively short duration treasury paper running off in a very mechanical and predictable fashion. The mortgage-backed securities, however, is lingering as the few high coupon securities held by the Fed prepay, but the rest of the portfolio of low coupon MBS is barely moving. More, the effective duration of the Soma MBS holdings is now larger than the Treasury securities owned by the Fed. What could go wrong, boys and girls? Now, I'm not going to read the entire article, but I am going to read one paragraph where he extracted a very important piece of documentation from another author. The gentleman's name is, boy, it's terrifying as hell. Bill Nelson from the Bank Policy Institute. I don't want to sit there and put anybody's alarm bells up tonight, but hey, if you're here on a Friday, grab a scotch, grab a martini, make it a double after you hear this, because you're probably going to want to. Quote, last week, Bill Nelson at the Bank Policy Institute published an important piece about how the Fed manages or fails to manage reserves. Think about that sentence. Listen to it carefully. Remember how the Fed managed reserves in 2006 and 2007, under Greenspan, before LTCM, and under Paul Volcker in 1979-1980. He noted, for example, that the model for liquidity used by the board was designed decades ago by Bill Poole to measure liquidity intraday. The model was never intended to predict liquidity needs over time. From Bill Nelson's article. Quote, there's a flaw at the heart of this conception of monetary policy implementation. The Fed seems to think that when it oversupplies reserve balances, Those extra balances just sit idly in each bank's account at the Federal Reserve Bank, ready to be redeployed in pursuit of higher yields. The mistake has arisen because the Fed is drawing intuition from a decades-old model of reserve supply and the federal funds rate that was intended to describe the relationship over a day. The mistake has caused the Fed to incorrectly judge that QE can fairly easily be reversed by QT, and to misunderstand the relationship between its balance sheet and repo market resilience. I'm keeping this paper for future reference. It goes into my historical documents in my safe. So if there's a nuclear war, maybe somebody can read it one day. Why is this important? When was that model designed? Anybody got a guess out there in MacroEdge Radio land? I did not know this until I read that article. The model that the Fed is basing its liquidity estimations on was designed in 1968, when we were still on the gold standard, before Nixon took us off the gold standard, before we had the great inflation and stagflation of the 1970s. But hey, what could go wrong with using a model that's that old? Anybody want to raise their hands and talk about it? Let's give one more clue, or let's do two more clues, to talk about the greatest number one investing vehicle in U.S. markets. For the record, it has yet to actually make a dime, produce a profit, and it first became public in the year 2012, give or take some time. With that being said, I'm going to open up the phone lines. I want anybody who wishes to speak to go ahead and raise their hands, request to become a speaker. What we want to hear is what's happening with your real estate markets, your restaurant markets, your individual financial situations without getting too personal or dramatic. What's going on with people you deal with in the business world? Are sales down or sales up? We want to know so we can take this anecdotal evidence and produce modeling in the future that might be more pertinent than the crap from 1968 that we're hearing from someone. And first up, we've got three aces. I'm getting it pulled up now. Sometimes, please understand, folks, the lag time for the stupidity of this X basis will drive you crazy. Come on. This is the problem with doing it through this. At three aces, you're up. Please fill us in on what's going on in your neck of the woods. Oh, you didn't hear me. Three aces, please come on board, sir. We'd like to hear what you got to say. And live radio is so much fun. X Spaces has really got to fix this.
Sorry, can you guys hear me?
Now we can hear you, sir. Come on through. What are you seeing in your part of the world? And you don't have to say what city, but what state are you contacting us from? Well, we had him there for a minute. This is the joys of X Spaces, folks. It's just the way it rolls. He's reconnecting. Apparently, we are having the usual. Elon can send a rocket ship up and land it perfectly, but he can't, for some reason, seem to get it on a consistent basis. Here we go. Let's try this again with three aces. There we go. Three aces, you're up. Welcome
Huge
aboard.
Fan.
Thank you very much.
Thank you. You guys are A players.
But I appreciate that. What state are you going to talk about?
Well, I'm from California, but I just thought you guys might find it interesting. I've lived overseas for the last 17 years. So in Africa, I'm in South America at the moment, and I own heavy industrial companies, mining companies. I make copper, gold. I own trucking companies, building infrastructure and so on. And I'm now in a country by the name of Guyana, which is just next to Venezuela and to the north of Brazil. And it's the fastest growing economy in the world. They hit a bunch of oil here. And I got news for you. I buy excavators and trucks and pumps and, that stuff every day. Okay. I have never seen anything like this. I mean, the prices are just astronomical for everything. And that's why you're seeing Newmont Mining and these other companies all crying about their costs. I mean, it's not even the diesel. Everything is just outrageous. You know, and I'm in the fastest growing country in the world. And the other thing is that inventories are absolutely inventories are absolutely through the roof. Up in there. Yeah. Sorry, my phone rang. You know, where Caterpillar 3 years ago didn't have one excavator for sale on the lot, they've probably got 200 now. And every other company, you know, Doosan, Hyundai, Komatsu, all of them, every single product you can name is loaded up to the gills. I buy dump trucks. I've got mining, you know, all that stuff. And the prices are outrageous. Almost to where, like, you know, you just like saying, I just got to wait this out. So sorry, my children are in California, in Corona del Mar, where they go to school with their mom. And that's where I'm from. But I just thought I'd give you guys, like, you know, when I see Caterpillar and these guys, their channels are stuffed, man. And the prices are through the roof. So something's got to give here. You know, something's going to have to give. Anyhow, I don't know if that was valuable to you, but I just thought you may get some insight out of that.
Absolutely.
Thank you very much for
Three
letting
Aces.
me
That
share
was
here.
absolutely what we're looking for, because Guyana is one of the fastest growing markets because of the oil discovery and the future Hess merger and acquisition. 110%. You are spot on. And the most amazing part about that is that we're still seeing a lot of the construction equipment, or we were until these hurricanes, being auctioned off and shipped down to South America. And now I have a feeling that there's going to be even higher prices because of the need for that construction equipment in Florida and what you were talking about in Guyana, which is exploding.
Yeah. So, you know, if you know anything about infrastructure, I don't, but I'm in the mining industry. So I picked an easy second business to open here, which is trucks. I haul stone for the government for all the roads and the bridges that they're building. So, but if you like were a developer and really know how to build something, bro, just send somebody here. The contracts are being handed out. I mean, you know, Guyana, the CEO of, is it Exxon, honey? Exxon? The CEO of Exxon was in the newspaper not long ago, and he said that Guyana, by the end of 2025, will be producing more oil per capita than any other country in the world. There's only 800,000 people here. You know, so it's a very interesting dynamic. But even in light of that, like, there is a logjam here. You know, like, there's not unlimited money and all that stuff, like people just doing stupid stuff. There's a enormous amount of inventory here at extremely high prices, and people are struggling, you know, to try to figure out. You can't just go back to the government and say, hey guys, you know, you can't do that, right? So something's going to have to give. You know, I can only imagine how it is in one of the states now. I do a tremendous amount of business with China, you know, in terms of equipment and stuff like that, and daily, weekly kind of thing. And they're literally dying over there. My guys who I know, they're my friends. I've been doing it a long time. We're kind of personal friends and all that stuff. And they're just like, man, like, it's ugly, right? Like, so whatever your vibe is on China, it's that bad. Whatever you might want to, you know, whatever imagination you have, it is that bad. Yeah. Over to you. Thank you.
Hey, thanks, Three Aces. And I had a friend who was big in Venezuela, Ecuador, etc., during the first oil boom, and he was telling me about how CNOOC was on every flight that he was on, moving around South America. And amazingly enough, you've pretty much filled it in. They're working to try and establish and keep market share in those regions, whether it's providing drilling equipment, heavy duty equipment, competing with CAT, etc. You nailed it. And I think your input was valuable. I appreciate the heck out of it. And don't remain a stranger for these open phone lines, sir. We love to hear from our listeners. Kalani,
Hey,
Oh, go ahead. Go ahead.
I
Jason.
got about 2 or 3 people on alert: Elon Musk, Donald Trump, and you guys. Thank you very much. I'm going to step down.
Anytime,
All
sir.
right,
Thank
good.
you so much. All right, I'm going to bring back one of the MacroEdge team, Kalani. You're going to be asked a very tough question after I give another clue. And my number one investment vehicle in the United States at this time in U.S. markets. Another clue for you. Many mutual and hedge funds are invested in it. Got a guess?
S&P 500 index?
That's incorrect, but you're getting warm. Folks,
Okay.
Kalani, who is one of our contributors to the MacroEdge team, I would like your take on today's market action. You've got experience with that. When you have a huge rally on bad news and it fails and folds over midday, that's not a positive indicator, is it?
No, not at all. First of all, how you doing, John? It's been a little while.
It's been a little bit insane in my neck of the woods because we're watching an economic crisis develop in Florida, not so much from a building or recovery aspect, but we're seeing non-essential spending dry up, and it looks like the only people who are going to do well this summer are the people who are visiting Florida, while the residents are cleaning a mess up, which will take about a year to restore back to some degree of fullness, not to mention the physical destruction of our properties. It's much like what you saw on your islands after the fire, except it's spread out over hundreds of miles in individual communities. It's a very weird situation. Not the first time, not the last time, but it is going to take some time to recover.
Well, all our thoughts are with you folks in Florida, as well as North Carolina and Tennessee. So I know it's tough times in some places. I have to apologize. I organize my thoughts before I raise my hand to speak in these weekly radio sessions, but I haven't had a chance to do that this week. We've actually got some friends, some close friends from the mainland visiting, so I've been busy hosting all week. But there's a couple things that I'd love to talk about and share. First, earnings. After earnings concluded last quarter, I called a top in earnings, and so far I've been right. So just to be clear, I'm not talking about earnings per share. I'm talking about gross revenues. The numbers that are hard to manipulate without committing fraud. That's what I focus on. So when looking at companies' revenues month over month and year over year, outside of a few mega caps, the numbers haven't been good. So that's definitely jumped out at me. I think, when I take a step back, the average investor is really missing the forest through the trees, so to speak. And I think some of that at least might have to do with the fact that government agencies have really been baffling us with bullshit all year because it's an election year, obviously. But I think investors really need to just take a step back, apply some logic and what I call uncommon sense to what we're seeing. One example that I posted about earlier um, was about GDP. Regardless of the GDP numbers being reported this year, I think it's incumbent on people to ask themselves, how can the economy be growing when private sector jobs are negative? That doesn't jive. I think people need to start really applying what I call uncommon sense to some of these things that we're seeing. I think economists, investors, we all tend to overcomplicate things when most of the time it's unnecessary. We're at the end of the cycle, everyone. I mean, I think the evidence is overwhelming. The same nonsense, at least throughout my lifetime, has happened at the end of every cycle. So, I guess a question to ask is, can anyone accurately tell you the exact date a recession or bear market will begin? No, of course not. But that doesn't mean the average investor shouldn't be very proactive right now about managing risks. And that's really what's been on my mind this week.
Well, I'm looking at it from another perspective. I'm looking for something tonight to occur, which happens during these quarterly reports, which I find to be an important practice. And that is they give you an 8K announcing their press release with their quote unquote investor presentation and saying, here's how great we are, or we don't suck as much as you think we do. And oh, by the way, we're going to buy some stock back, Kalani. But then all of a sudden on Friday nights, the 10 Qs appear and you start going through the blue bar and you go, Jesus Christ, what the hell's going on with this company? I find that practice to be somewhat objectionable, but then again, it's a rigged game. Agree?
Absolutely. They've been playing I mean, I spent 24 years in the business, and I've been out of the day-to-day business for 6 years now, I think. My entire adult life, that's what they do. That's the game. They'll lower earnings expectations right up until the week before they report, and then they'll call it a beat. They've been doing that forever.
Well, we call that the Apple model. And
Well, that's why I focus on revenues. I mean, literally, that's the only thing you can't fudge without committing fraud is gross revenue.
Well, yeah, we'll ask Super Microcomputer about that at a later date.
Yeah, exactly.
I mean, that is the ultimate disaster for the week, and I believe that's going to be the poster child for this upcoming correction, and we'll use that word politely when most of us know what it really means. Real quick question. What do you make of the desperate, in my opinion, desire to expand trading to 21, 22, 24 hours a day when there really isn't a lot of demand to trade at 3 a.m. Eastern time?
Like I said, I've been hosting guests all week, and that came out. And when I first saw it, I kind of laughed. Um, Honestly, it's probably just the exchanges grasping for more revenue. I don't know what else to think of it. I think you're right. The demand is not there. The last thing I want to be doing is watching markets 24/7. I, I I don't know. It's just the continued, gamification of financial markets. They call it progress. I see it differently.
Yeah, you can have an online casino, make sports book bets 24 hours a
Yeah.
day, which I understand, or you can buy stocks. I don't see much of a difference at this point in time. It's no longer investing, it is pure casino gambling.
Yeah. I don't see any other way to look at it. It's no everyone has as much access to financial markets as they already need. So I don't see the point.
I mean, that's a key question for you because of your experience in the markets and investing, et cetera. When you look at the big picture, is this not a time to start shielding assets into safer trades? And when I say that, I also include the bond market is becoming a very risky trade as part of that picture.
Absolutely. The risks have been present for the whole year. If you're not at this point, if you're not hedged, or if you're not being cautious in some way or another, I don't know what to tell you. The signs are everywhere. So I couldn't agree more. And it's really inexpensive and easy to hedge a portfolio now. There are multiple ways to do it, and they're not complicated.
Oh, that's what my point was. I also noticed that a lot of people are sitting here and selling into what I like to call the public trade. If you're following, it usually means you're behind the curve as far as what the bigger houses are doing and preparing to do. When you see everyone hurting themselves into that one corner, does that not scare the hell out of you? Because this was not a high volume day by any stretch of the imagination. And this was not a conviction move. It looks again like this week, as markets advance or try to advance, there was widespread distribution by the larger houses.
Absolutely. There is more concentration risk right now in equity markets than I have ever seen in my 30 years of or 30 plus years of being in financial markets. It's not just about everyone's being in the top few stocks like Microsoft or Nvidia. It's also market structure. There are more, and a lot of people don't know this, there are far more ETFs, ETNs, and mutual funds than there are actually underlying stocks now. That's not a stable market structure. And when everyone starts heading for the doors, we're going to see things we've never seen before because that concentration risk has never been greater.
I've offered my opinion in writings on ETFs in the past, and my concerns about ETFs is widely known that this is the equivalent of the models used in the late 1920s to sit there and con the public into holding groups of stocks and thinking that they were actually investing, when in fact they were gambling on what the big houses were doing with key equities. When you hear people creating ETFs and ETNs on market action versus actual companies, is that not a signal, or in your opinion, this is an opinion only, this is not a factual statement, folks, this is not an investing advice or disadvice, do you not feel that this is indicators of a market top potentially being set?
Absolutely. It's greed. And when greed is at its highest, markets are at their riskiest. And the only thing driving it's like you said, it's gambling. It's 20, whether it's extending exchange hours to 24 or 22 hours a day or whatever it was, to offering more and more products that include more and more leverage. It doesn't end well. It never has in the past, and it's not going to end well in this cycle. And we're right at the end of it.
I appreciate that. And I'm going to give you two more clues to guess what the number one investing vehicle in U.S. markets is. And this is for all of our listeners. If you want to raise your hand, you can do it online. If you don't want to be come on air via the MacroEdge feed. Next clue, bigger than Exxon and NVIDIA, but also always announcing stock buybacks. Got a guess? I guess Kalani doesn't. I don't know if you heard me or not.
Oh, no, I'm sorry. I thought you were asking the group.
Oh, I'm asking everyone. I'm throwing this out to you for one more guess before I let you go, because we got more.
Wait. I'm sorry. Ask that question again.
Okay, two more clues. Bigger than Exxon and NVIDIA, and always announcing stock buybacks.
I don't know, Apple or Microsoft?
Keep going. I'm going to keep everybody on edge in this. Connie, thank you so much. And please, we look forward to your contributions every time you come on the air. Get us an update, by the way, on how things are going in Maui, so next time we talk, we can update all our listeners. Well, there's been a lot of interest in that, and I think we need to keep everybody informed, because I'm hoping and praying that market springs back. It is very sad what's happened out there. It truly is.
I appreciate it. Thank you, John, for the time.
Thanks, Connie. And folks, anybody else that wishes to join in, raise your hand in the room, request to be a speaker. I am more than happy to add you. We can keep the show going on beyond the normal 1 hour format. We just have to have input from our listeners as to what's going on. We had some great input from Three Aces about what's happening in Guyana. That doesn't surprise me. Capital always pursues the next great area for profiteering, and that is an easy flow. It's a cheap market. There's widespread mineral and oil, petrochemical assets available there. You could see a boom in that region. And that's why Venezuela has been beating their chest and threatening to invade with their 100 Boy Scouts and attack that country. Highly unlikely that would happen, because of the Brazilian government has already promised to sit there and intervene. That's just a fact. That's reality. When Kalani was talking about earnings, whether you know it or not, I've been following the transportation earnings, and the bifurcation in the logistics and transportation industry continues. You see C.H. Robinson, J.B. Hunt, certain larger corporations that I wrote about on MacroEdge.net a few weeks ago, surpassing expectations, not exceeding in a great manner, but doing better than the average trucking companies. When you look at the truckload carriers and you sit there and focus on what's happening, the people and the corporations that were handling small companies, intermediate-sized trucking companies, and even large truckload carriers that have less of a contract carrier basis, don't have a great intermodal footprint, don't handle a lot of the import-export deals, they're hurting. They're not doing well. Their operating ratios are blowing out. Their costs are skyrocketing, even though the biggest expense, fuel, has declined dramatically. Labor has increased in cost to offset that. And the key there is People want to keep their qualified individuals on staff. They don't want to let any of the drivers go. They don't want to let go of their operations people, etc. The truth is going to come home. This surge in containers, imports, etc., was a one-off event to stock for Christmas. And it's a huge gamble by retail in America, including Amazon. If, in fact, this Christmas season is the one that marks the extent of the credit card spending crazy consumer coming to an end, auto sales, home sales, and of course, big box and all store retail, including Amazon, is going to show a massive decline as the individuals are maxed out. As we talked about with Melody a few weeks ago, if you didn't get that show, it's available on macroedge.net and on MacroEdge's YouTube channel. You can sit there and hear the concern that she had, I had, and many others have had. The Airbnb bust is getting ready to explode. And I'm going to bring Hypnotoad up before I bring Joseph up. Hypnotoad's a longtime follower and listener. And welcome aboard, Hypnotoad. If you can hear me when you're ready to rock and roll, please tell us what state and what kind of information you have for us, sir.
Sure. My state is Washington. I live in the Olympia area, so I'm a state worker here. And so that means our economy is a bit different than other areas since we have the government employees here buoying the economy at all times. But what I have noticed is you already hit on the heavy equipment dealers. My area, you go to the rural areas, and I literally saw a heavy equipment dealer that had their lot full and then moved every single piece of equipment and filled up their lot more so the tires were touching. I've never seen anything like it. It's a bit crazy. And along with that, I see the lumber yards. Obviously, lumber is a huge thing in our area. They're completely stocked up, more than I've ever seen them, even around 2008. It's insane. And with that, I actually have a question for the group. What happened with lumber prices today, and why are they skyrocketing the last little bit here? It's not really trending with what I am seeing going on macro-wise. It's not making sense to me. So I'm just wondering if anybody can fill me in on that.
I'll throw my 2 cents in on this, and I can tell you why we had a almost 2% increase and why it skyrocketed in the last week. And this is purely a local bias, but I'm sure it extends in that swath from Southwest Florida all the way to North Carolina. The massive amount of rebuilding is going to require more lumber than anticipated. This is not a home building boom. It is a home repair boom. And that's just my 2 cents. If you fly over the state of Florida right now, you'll think that our state flag is a blue tarp, because that's on every rooftop that you can see, Hypnotoad. Real curious about something. Do you think this heavy equipment thing is more related to construction or mining activity in your region?
We don't have a lot of mining right in my area, but I'd say more with building. The builders are crashing in my area big time. Lumber is also crashing. There's actually development that look like is going to be developed into actual, residential development. Hard to say, but the lumber companies now selling off for pennies on the dollar, and it's in a very, very nice area actually for development. But they're just dumping land like crazy. It's really insane, actually. I've been looking for land since about 2015 in my area, and I've never seen the market like this at all. It really is insane, and lumber companies are leading the charge.
What do you make of the political situation? The rumors are that, and this is a actual economic political question for you, and this is opinion only. I know no one has any facts. We have pretty good information in Florida that Amazon is moving to Duval County, their entire headquarters, within 2 years. What is the perceived impact psychologically on your region if that were to come true, or do you have any feedback on that yet?
So they've threatened to move out multiple times. We've had, Boeing pack up and leave Chicago. That was 15 years ago or so, 20 years ago. It's pretty normal psychologically to us at this point. People don't expect companies to stay in Seattle any longer. Just kind of known that they will leave, especially if they're deteriorating downtown. Downtown is dead and dying. It was already peaked prior to COVID, but it's just going downhill very fast. But Seattle's a very boom and bust town. I'm not sure if all cities have that going on. No, it's kind of the thing that does happen to metro areas. You saw it happen in New York. and stuff, obviously in the 70s, 80s, and then resurgence in the 90s. But Seattle is really boom and bust. You can look at the population figures going back to the 70s and 80s. It's just constantly gone up and down. So I'm not sure how much that is just local or not. But yeah, psychologically, it probably won't impact us that much. We're kind of used to losing headquarters.
I totally understand that. Yeah, the land has been purchased, so we're sort of anticipating a boom for that region. And Duval County is part of the cheapest part of Florida, in Northeast Florida, so it's logical. And not to mention that under the current leadership, we're willing to sit there and hand out blank checks to build whatever the hell you want to in our state, and it's going to be an interesting evolution. With that being said, Hypnotoad, thank you so much for your contribution. Thank you for being part of the show. Joseph, one of the MacroEdge team, welcome aboard, sir.
Hey, John, how you doing today?
Not bad, sir, not bad. I was able to hit happy hour at noon, say goodbye to one of my vendor's key employees that I've been dealing with for several years, and she's moved on to bigger and better things. Probably smart considering the industry I'm in. So what is new with you, sir?
Well, I was just kind of listening to you here, and like my feed kind of jumped a little bit on me. But you were talking about freight, logistics, the state of the trucking industry, and all that. And it is really curious to me, especially coming off of like earnings and stuff like that. The greater market has such a disconnect. If Maersk is guiding higher going forward, record demand, they're saying. They're also showing container ship demand, but at the same time, you have these other circumstances that are occurring, right? You have container shortages, you have extra capacity, you have a week or 2 week of lead time on some of these ships for ocean freight. So, the extend and pretend and the entire economy as a whole, everyone is just in this kind of euphoric speculation on it, and there's always something that goes along with it, which to an extent is natural. We expect that, but you can't, and like you guys were saying earlier, you can't unhedge something like that. Like you have to. It's not something that I think anyone can go into without having at least a proper portfolio hedge in place, because this euphoria that we seem to be living through, and even with the 2 or 3% drawdowns, it's just unrealistic. And even by the Fed's own admission, it's unsustainable. The freight market's been in a recession for over a year. Less than truckload carriers, contract rates to spot rates, they've had 2 or 3 attempts at a good recovery since summer of last year. And you and we've talked about this a couple of times. They just haven't played out. So where along the lines in the economy is this gray area that we seem to be getting through? Because I couldn't tell you. So it's really interesting when you look at the entire economy like that. So I really liked what you brought up there about the freight.
Well, the reason I bring that up is that logistics is the bloodline for capitalism. And if you understand how it's flowing through our nation, you understand where the supply and demand curve is. And we're seeing a growing weakness in aspects of the economy that aren't being highlighted by the media. And one more quick plug, folks, macroedge.net/ozone. Subscribe today, get 2 weeks free. We're trying to stay on top of that and identify either key risk areas or investing opportunities. Read the data, understand where we're headed. The unemployment preview, non-farms preview, was excellent. Mine was a little off. I was not expecting to see a massive decrease in private payrolls. I thought they would extend and pretend it another couple months to get through this election cycle. The record I wrote on Patreon, which is my short-term phone scribbling ability, a short article. For those who do not know, this was the worst presidential election year non-farm payrolls report in the last 24 years, except for 2008. And 2008 was a disaster. Disaster, folks, when you read that report. So if we're going back to this kind of reality, it means we're going to see an ongoing crisis as it goes down the cycle. It's looking more and more like a 1970s stagflationary cycle. And for all of you who are too young to have borne witness to that, you're not going to have a good time, either in equities, bonds, precious metals, or anything else. The cycles are going to get more violent. The moves are going to get sharper, except this time we're a debtor nation to the world and to ourselves. Joseph, I got a question for you. What are you seeing in your neck of the woods?
Well, I live in the Midwest. Manufacturing is huge out here. We do have a lot of less than truckload in Southwest Michigan, but as you would expect, automotive and general manufacturing, right? So over the past, I think 6 or 8 months, there's been a notable decrease acceleration, in the decrease in manufacturing. And we do see a lot of that stuff around here. Local unemployment's ticking up slightly at this point, but in the automotive sector, it's huge. And I know I've talked about it a couple of times in the group and written about it a couple of times. The Ford Blue Oval battery park. That's not too far from me. It was going to be massive. State was going to pay tax easements and all sorts of things for it, and it just kind of got shoved down everyone's throats. Then they come to find out it was a cattle plant, so through China, and it all just kind of has ground to a halt. There hasn't even been a local news report on this big, awesome EV F-150 Lightning battery plant at all since July. So we're kind of seeing that undertone of lack of manufacturing strength. Lack of sturdy foundational growth within the Midwest is important just because it connects, for the main part, the majority of the country. You get a lot goes through here. So when you start to see these areas, mine included, but I understand it's very user specific in my case. I live in this area, and it's only one story. However, you see how it fits the bigger picture here. And unemployment, like we said, is trending up. We don't know what's going to happen with that plant, locally, but I do know that it was fought and is fought currently because it was just one of those things. Oh, yeah, here it is. It's brand new. You guys don't get a chance to speak about it. And they took up good quality land, quality farming land from a farming community. To build a battery plant for a truck that they're not even going to be producing through November for a while. So we see a lot of that undertone, and it's getting close to winter. So, we kind of trudge along like everybody else in the aspect of everyone just kind of gets by. The people that I see on a day-to-day basis, they say a lot of the same things. It's expensive. We have record numbers of families at food pantries. So these things are real, and that's one of the great things I like about coming on when writing, especially with MacroEdge, is that we give a little bit better clarity or granularity just to some of these industries, and it's fantastic. So I want to thank everybody for that.
Joseph, thank you so much. And now that you came on the air, you get trapped in the Kalani trap.
Oh, really?
The number one investment vehicle in U.S. markets right now. I'll give you 2 more clues, and then we'll open it up one more time to listeners at the MacroEdge feed, and then I'll reveal the answer at the close of the show. And 6 is probably listening to the program too, saying, I got to hear about this. Kramer promotes it all the time whenever he's on television, and bond traders avoid it because it's radioactive. Got a guess?
Oh, it's a leverage utility, or it's a leverage. No, I can't think of it other than CLOs, which you guys know my opinion on those also.
Well, I think after reading the commentary from Chris Whalen, and I'm encouraging everybody to read macroedge.net/ozone, get your 2-week free subscription. Shameless plug. And at the same time, read Chris Whalen's article on Monday if you're not a full-time subscriber, insider, etc. The problem with CLOs is about to become visible again, and we're going to relive some of the nightmare of the GFC. If the Fed is owning that much MBS in a bad duration curve, things will start blowing up because because it also means banks own it also. Joseph, thank you for your contribution today, buddy.
Hey, no, thank you. I appreciate it.
Thank you, sir. All right, folks. I'm going to hit some highlights here before the election, and I'm going to tell you what we're about to inherit as a look ahead for the future. This is John Galt, FLA's opinion, not the MacroEdge team. I will be writing about it this weekend. But here is what is coming up as we move forward the next 90 days. And this should scare the hell out of everybody. One, the East Coast port strike. Odds on the betting markets are starting to increase. Yes, there are individuals who are wagering on the betting markets of whether or not the East Coast strike for the port workers will return. Two, the election dysfunction. It is a risk you cannot measure. There's no quantifiable or quantitative way to figure out what the hell is going to happen. And if anybody tells you that next Tuesday is going to be it'll be done by 6 a.m. Wednesday morning, God bless them. My personal opinion, I'm going to check on the results for what's happening in my state, my locale, and I'm going to bed early that night. I really don't want to hear a lot of people yelling at each other about total nonsense. Although I might wake up in the middle of the night and take a peek at markets. That'll tell you more than anything. Retail collapse. I hinted at that with the transportation. I think that is going to be the story of Q4. Retail is in a lot of trouble. And you see it when you see people who think, well, the inflation cycle is over. Well, what if it's a stagflation cycle? Individuals cannot afford the credit card payments. And if you saw the data that was published earlier this week, where 27% of all consumers are still paying off Christmas from last year, you might want to think twice about going long retail. Just my opinion. Geopolitical uncertainty. I highlighted the oil price swings today, where it was up over $1.50, and now all of a sudden it finishes essentially flat. You have no certainty as to what's going to happen overseas with Ukraine, with China, with Taiwan, Africa, South America, Central America, Mexico, and on and on and on. The two big ones in my book, besides the Federal Reserve, which we've already talked about, the Japanese yen-US dollar trade. The carry trade is in deep kimchi. Oh, that's Korean. It's in deep crap to clean that up. There is an issue that's arising where the Bank of Japan doesn't know what to do, and political influences are starting to weigh on the ability of the BOJ to act. We could see a boomerang effect where either the yen explodes back up over 160, or the Bank of Japan suddenly decides to get serious about defending its currency and hedging off against inflation and moving it back under 135. That's a scary thought because too many people are flat-footed and on the wrong side of the trade. Today we got to watch the trust effect. Everyone forgets who Truss was. Well, let's just go back to the British pound and what happened with gilts. The gilts blew up again today. We reached over 4.5% or something like that. I got to go back and look at all the charts. Things were flying through my screens at light speed today. And besides the bullshit, the high quality data from the Bureau of Labor Statistics, there was a scare initiated by the move in gilts. And before everyone says that doesn't impact us, our banks are heavily invested in that. And it could be a major problem. And last but not least, next week, I anticipate the Federal Reserve making another mistake. And when I say another mistake, I mean another classic Jay Powell blunder. When you say, what is a Jay Powell blunder? Well, they could do nothing. That's a mistake. They could cut by 50 points. That's a mistake. They could cut by 25 and give an erroneous outlook. That's the disaster. And that's what scares me about this. They don't know what to do. Jay Powell says he wants to be like Paul Volcker. Well, guess what? He has a chance to go down in history to be just like Paul Volcker, who took rates up to almost 20% in 1980-81. Because that's what it might take to kill inflation. And if anyone thinks, regardless of who the president is, that a 7, 8, 9, or 10% Fed funds rate won't create political instability, you haven't been paying attention. Reminder, don't miss MacroEdge.net. Get our exclusive updates. Get the information and charts you need. Follow along and pay attention to what's really happening. And by the way, if anybody wants to debate us, please jump on the MacroEdge feed, because I'm going to give you the #1 investing vehicle in the United States markets at this time. And that might just make you think for a minute. The name of this #1 investing vehicle is narrative. Nothing else. Everyone is investing in the narrative. Let that sink in. And starting next week, our guests shall return. Less John Galt, more guests, and even more information provided through the pages at MacroEdge.net. For MacroEdge Radio, this is John Galt. Good night now.